Hello and welcome back to Aki Trades. Before we begin, I just want to do the usual trading video disclaimer. This video is for informational purposes only. These are not recommendations to buy, sell or hold any type of security, and I may hold positions in some of the equities mentioned. Know your own time frame and risk tolerance. Okay, so with that being out of the way, I want to make a video series about something that I call earnings gappers, and this is the first episode in this series where I will kind of introduce the concept and roughly kind of show how it works. And I got this concept from an article on Quullamaggie's webpage, and he calls it Episodic Pivots. And he kind of includes things like political events like elections that might affect stock prices, and things like drug discoveries that obviously can have a huge effect on biotech companies, and many other kind of inflection point kind of catalysts like that. But he also includes earnings gappers or earnings events, and I call them earnings gappers, and I think Qullamaggie on one of his Twitch streams call them earnings gappers as well. So that's kind of why I use that term, because I think it sounds kind of funny and I like it. So as I said, in this series, this will be the introduction episode, and then I want to make an episode about how I screen for earnings gappers, kind of how I find the ones that I want to play. And then the next episode after that will probably be about how to execute an earnings gapper, and there we will go in quite in depth on how to trade them basically. So to give a kind of TLDR of what an earnings gapper is, so this is NVIDIA, so one of the most famous examples in the last kind of year or so. So NVIDIA reported earnings on 24th of May 2023. And as you can see here, the next day, NVIDIA went up, 30% or something like that. And that kind of creates, because they reported earnings on the 24th of May after market close. And then in the aftermarket, they started going up. So that's kind of created a gap on the daily time frame of the chart. And also, if we look at the day after earnings, the 25th of May 2023, earnings gapper should ideally, but not always, but ideally be accompanied by huge volume as well. So here on the daily time frame, we can see that the daily volume was 154 million shares. Versus an average kind of daily volume of 46 million. So 3 times the amount of average volume. So that's kind of what creates this huge kind of moving price. So if we take a step back and kind of think about how stocks move, just to kind of set this up, and stocks can obviously move downwards, and they kind of trend downwards in a downtrend. Asset prices tend to trend, or they move upwards. So again, trending upwards. And this is obviously more fun if you're on the long side. Or they can go sideways. And this is kind of, if you bought here, then they go up 1%, they go down 1.5%, and so on. So this is very frustrating, and this is what the famous technical analyst JC Peretz calls a hot mess, because they just kind of go sideways, kind of trendless, or I guess they trend sideways. So this can go on for a long time, like 2 years or something, in some cases. And I might make a video at some point about Stan Weinstein's stage analysis, because this is what he would call a stage 1 base in his framework. So if we think about a stock that kind of moves kind of slightly upwards, and then at this point, say that it's worth 10. And that's kind of like, with all the information that, Wall Street and all market participants that kind of interact together in the market, collectively at this point, with all the information we have available, we have decided that the stock is worth 10. So some people might think that it's worth 20, some people might think that it's worth 1, but if you would buy this stock right here, right now, it would be $10. So that's kind of, that's kind of the truth. And yeah, you can't really argue with price. Then say at this point, there's an earnings event, and say that stock XYZ, company XYZ, they come out with the last quarter's earnings and say that they made 10 times the amount of money that everyone thought that they would make, all the analysts on Wall Street and stuff like that. And say that they say for this financial year, they think that they will make 20 times the amount of money that they previously thought. Then obviously the stock price will go something like this, kind of off the screen. And say that it's now worth a rather aggressive example, but just, to make the math easy, and let's roll with it. So say that it's now worth 20. So based on the information we had back here, it was worth 10. And now with the new information that we had with these amazing earnings and, the new forward guidance and all that stuff, now the market participants think that it should be worth 20 with these kind of new circumstances. And so this kind of inflection point, kind of catalyst that, introduce new information to the market, that kind of means that all the market participants quickly have to kind of reprice the stock from what it was back here at 10 to now 20 with the new information. And that obviously creates a huge change in the stock price. And kind of the idea with an earnings scalper is that we want to, of course, get in as quickly as possible when this kind of catalyst occurs. And then we want to get out, either based on some kind of, exit strategy or, a certain percentage move that we kind of figured based on previous events like this. We think that it could move 30%, so after 30% our trade is done. Or, something else, like for instance, say that it's, if this is the day after earnings and it makes this move, say that the next day it kind of does like that. And then the day after that, it goes up again. So say that then it goes to like 30, for instance. So then we can say, okay, your first stop with risk management would go here after you bought it. And then, say that you sell half your position at 20, then you will set your stop here after it starts going up, and then you will sell at 30 or whatever. There's many ways to do it. But, that's trading is very personal. So, you kind of have to make this your own strategy. And in Quullamaggie's article, he says that the way he screens for it is that, basically if we have a stock, again, that goes like this, and this is the regular market hours. And then they report earnings after the market close, and then they go up, say, 10% in the after hours. And then the next day opens and they go like this. And then, the regular session opens and it say goes up another 20% in the regular session. So he would basically screen at stocks that move a lot after hours or, pre the regular session on big volume. And then he would basically, at least what he says in the article, he would get in at the opening range high at the regular session. So say that it opens here and then it goes down a bit, and then it breaks the opening range high, and then say it goes up another 20%. So he would get in here at the break of the opening range high, and then he would set his initial stop at the low of the day. That's kind of how he explains his strategy in the article. And I will link the article in the description to this video. So when I first started playing around with this technique, it was about a year ago now. Then I kind of, the first ones I did, I was kind of doing it this one, like this style with screening, and then based on volume and the kind of initial gap, and then kind of getting in at the opening range high, and then playing it like that. And then one time I was kind of by mistake, I had a buy order outside regular market hours, and I kind of got in at this point, and I was in the initial move of, like whatever it was, 10% or whatever, 20%. I was like, oh, great. I got an additional 20% of this move that I kind of thought would occur. And so nowadays I kind of, a lot of the time I do it I play earnings capper in after hours, because then, you kind of have all the kind of data from the regular session, and, and then, but there's kind of pros and cons of both techniques, and obviously after market hours and pre-market, there's a lot fewer market participants. So trading is really, really volatile, and it's really hard. So, maybe getting in at regular hours can be, easier to some degree. But, it's, like I said, it's a personal choice, and I had some success with both techniques. So basically, to summarize, it's an earnings capper is when a new information comes in that makes the stock make a huge move based on that new information. So it's like a catalyst or an inflection point, and the market quickly have to reprice what the stock should be trading for. And we want to get in as quickly as possible at this point. So that's kind of the quick way to describe it. And just to show another thing why this can be a kind of powerful technique. So if we look at gold, for example, so gold at the moment moves at, if you look here, so we have ADR percentage average daily range. I think it's the last 20 trading days. The average of the last 20 trading days. So gold at the moment is moving an ADR percent of 1.1, which means that on average it moves 1.1% per day. So basically, if it opens here, it goes up 0.5%, it goes down 0.5%. On average, that's a 1.1% average daily range. Or if it opens here, it goes up all day long, and it goes up 1%. That's kind of the same thing, right? So ADR percent, that's one thing I use to kind of screen for kind of how fast a stock would move. So obviously, if you have an ADR percent of 5, it's a lot faster mover, both up and down, of course, than an ADR of 1. So, really kind of establish kind of a bit, slower big cap stuff. They would usually have like a lower ADR percent than something, like a young biotech or something that can move like, 50% in a day. And obviously that's kind of also like a measure of the volatility. But the reason why I bring this up, so if you think about gold, for instance, so an ADR percent of 1.1. So if gold would just move up every single day, then it would take, for an 11% move, it would take 10 trading days, right? So 2 calendar weeks. So, and that's if it goes up every single day. So it's obviously quite slow like that. And earnings cappers can, easily move like, 20-30% very quickly due to this kind of repricing with the new information. So that's kind of why you get these huge moves, and also, why you get a gap on the daily time frame, like I showed with NVIDIA. So that's why I think earnings cappers can be quite a powerful kind of strategy, and, a tool that you can add to your toolkit. And obviously it comes with, a lot of volatility and risk, and, like everything else. So if we go back to NVIDIA and show some examples. So just to show kind of this one that we kind of showed in the TLDR again. So we have the earnings, they reported earnings the 24th of May 2023 after market close. I think it was about 9:15 my time. And this was, early 2023, spring 2023. That's when the whole kind of AI thing kind of started. And this is kind of when NVIDIA came out with amazing earnings, because everyone wanted to buy their H100, I think they called their AI chips. And they also, I think, upped their guidance for the full financial year that, we're going to sell loads of these chips, and we think that we will make X amount of money. And that kind of took everyone by surprise, because by May 2023, AI was still kind of like, you know, it was very hot, but it was still kind of a new thing. And NVIDIA, you know, everyone wants to buy these chips, and everyone kind of understood that NVIDIA would be one of the bigger players, if not the biggest player in this kind of new AI trend, right? So that's why we get this kind of huge move of 20%, you know, huge for a normal stock. And so if we drill down to like the 10-minute time frame, and we go back to 24th of May. Okay, so here we can kind of see how it looked like on the, because obviously on the daily time frame you can't see the data after hours, so that's why you kind of get the gap. But on the 10-minute time frame we can. So the kind of dark blue shade, kind of the moon blue, is after hours. So after 9 p.m. my time and after 4 p.m. In the States Eastern time. And then the yellowish tone is pre-market, so before 9:30 in US, so Eastern. And then the kind of gray tone is regular market hours, right? So 24th of May 2023 was when NVIDIA reported earnings, and after market. So here you kind of see the regular session, so kind of sideways. And then quarter past, I think it was, or maybe 20 past, that's when they reported earnings. And you can kind of see that straight away the stock gapped up, or, you know, went up 14.79%. So the stock closed at 305, and then it kind of went up to 395 or something like that. So that move is kind of, you know, like I said, 29-30%. And then you can kind of see that it's kind of peaking here in after hours, and it starts fading a little bit. Then in the pre-market the next day, it starts by gapping down, and then it goes up a bit, and then it goes down a little bit again. And then in the next day, it kind of fades a little bit after the day. So actually the kind of big move that started straight after earnings, that was kind of done like after an hour, like, yeah, 6 bars. So that was kind of the majority of the move. And then, you know, it kind of digested this huge move in price, and, you know. So obviously, like I said, the goal here would be to, you know, because you have this range, right, on the 10-minute, or it could be whatever time from you want to use. But so you have this range, so you would want to get in just before, you know, like if they break these highs, the closing range highs, then I want to get in with a buy stop limit order. And then obviously, so you would get in, excuse the messy charts, but you would get in, say, there. And then say if it did like this, so it went up a little bit and then it went straight down, your stop, if you use stops for risk management, would go like under the kind of the closing range, something like that. So then if we would go up and then it would go straight down, and that often happens, for instance, you know, if they would say something bad on the earnings call after the results are released, so say that everyone thinks that the results are great, but then on earnings call they say something like that the market doesn't like, then it can quickly reverse. So then you would get stopped out here, right? If you use stops. So that's kind of, you know, in a nutshell how you would play something like that. So let's just have a look at one more example. Yes, I think it was. So this one. So this was the next earnings, I think. Yes. So the 23rd of August 2023. So this was the next earnings after that. And I was actually in this one in this one. I didn't really play it as an earnings scalper, but I was in it like from before. And 23rd of August. Okay, here we go. Yes, 23rd of August. So again, we see, let me just tie that stuff. So again, we kind of see a similar setup, right? So kind of this is the regular market hours, and then earnings come out again like quarter past or 20 past my time. And this, in this case, we have a move up of 7.7%. So again, you would get, you would get in at like the opening range, closing range highs, or whatever you used to get in. And in this case, we see that it kind of peaked, similar thing, like kind of 50 minutes after earnings, something like that. So it peaked here, so it went up 9.7%, and then it peaked and it kind of started fading in the after hours, and then the next day it kind of went sideways, faded a little bit, then it kind of regular hours, the day after earnings, it kind of faded pretty much the whole day, right? And so we see that at the close of the day after earnings, it kind of it was back to where it started just before earnings. So this is what can happen as well, that it just goes up and then the market digests it. And I think in this case, I think the markets, like the indices like Nasdaq and SPY, I think they kind of peaked in late July 23. So I think like another thing with earnings scalpers is like you kind of have to have the overall market in your favor as well, most of the time, because when the markets are bad, even if the earnings are amazing, they can often kind of fade like this. And I think that was kind of the case in this case. So yeah, I think I was in this before, and I think I kind of just by luck I saw that someone wrote something that the expected move, percentage move based on options was kind of 18%. So I kind of calculated somehow, I can't remember how, that it would be like around 515. So actually very lucky I got out at 515, I think, in the after hours on this candle, I think. And yeah, that was just kind of pure luck that I read that. But I kind of thought, that it was a little bit late, kind of from the initial thing in May, and it was kind of like a little bit late. So I didn't really think that it would make like the 30% thing again. And just luckily I was kind of like, I wanted to get out because I think the indices had started, the market overall has started turning in late July. So I kind of wanted to get out anyway. So I think I got out at 5:15 or something like that. Just kind of lucky. And if we go back to the daily time frame. So where were we? Oh yeah, here. Yeah, so I think the markets kind of peaked somewhere in July, August 2023. Can't remember. So, but you see, like after that big gap, they kept going up, and I think so this was actually the peak, the kind of short-term peak at least, and then they kind of just went sideways from say July, August 23 to like January 24. So just kind of in this sideways range. I think it was kind of between 400 and 500, just kind of ranging. And or you can say it's like a Darvas box if you read Nicholas Darvas book. So just kind of in this Darvas box as well. And then in January 24, of course, it broke out over 500, and I went on this huge move to almost 1,000. So like 90% up or something from the breakout. And this is also like if you're kind of more, like I said, you kind of have to make the earnings scalper technique to your own technique, and it's based on your personality and the way you trade, of course, and your own process. But just if you get in here, in the May earnings capper. Also, if you're like a position trader, you could just, with risk management and setting your stops at, relevant positions, you could have just stayed in this entire move and, 220% move, which is huge for a stock, right? So yeah, that's just kind of to show that, you can play it like a really short-term thing and, just play for like the quick kind of initial kind of catalyst and kind of the burst. Or you can play it like a kind of position trade and kind of hold it for longer or whatever, whatever suits your personality and trading style, really. So that's kind of it in a nutshell. I think that's kind of it for the introduction. And as I said, the next video in this series will be how I screen for earnings capper. And for me, that's a very kind of manual process, and to separate out the ones I want to play each kind of earnings week in the earnings season. So that's what I have planned next. So I think that kind of wraps it up for this one. Please hit the like button and subscribe to this channel, and please hit that little bell icon too. And all engagement helps with the algorithm. Thank you very much, and until next time.